Good morning and welcome to the Street on BNN Bloomberg for a Monday. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Kyle Taylor, wealth advisor and portfolio manager at Tri-Delta Private Wealth. He'll be joining us now for the hour. In 30 minutes, we'll chat with Drew Fagan, professor at the Munk School of Global Affairs at the University of Toronto, for his take on the Canada-U.S. trade talks as the new advisory committee meets for the first time today. And we want to hear from you this morning on First Call. Reach out with your questions on stocks, and we'll have Kyle answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address, if you want to go that route, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. There are numerous reports that Prime Minister Mark Carney will unveil a sovereign wealth fund today. The fund would be used to invest in major projects the federal government has committed to in the coming years. The plan would also allow individual Canadians to contribute. The details are expected to be presented at an event later today in Ottawa. Globe and Mail is reporting the federal government will forecast a lower deficit in its upcoming spring economic statement. The update is scheduled to be released Tuesday by Finance Minister François-Philippe Champagne. The current fiscal plan projects a deficit of more than $78 billion for 25-26, $65 billion for the fiscal year that began April 1st. Shares of Domino's are down in the pre-market after missing on earnings for the first quarter. The decline was primarily due to a $30 million loss from its investment in DCP Dash, a food delivery service that relied on independent contractors rather than in-store employees. Despite the results, the company remains positive, citing its scale advantage and its relative resilience as the broader restaurant sector comes under pressure. And now our top-line story. U.S. stocks remain near record highs at the start of the week. That will bring in a slew of big tech earnings, central bank decisions on both sides of the border as well. Now, taking a look, the S&P 500 is up almost 10% this month following a sharp rally in chip stocks and robust earnings, helping the benchmark to recover the losses after the war in the Middle East broke out. On the geopolitical front, oil also inching higher as the Strait of Hormuz stays closed and blockaded after the U.S. president canceled a trip by top envoys to meet with mediators in Pakistan over the weekend. So let's see how investors should try and position themselves amidst all of this that is unfolding with our guest for the hour, Kyle Taylor, wealth advisor and portfolio manager at Tri-Delta Private Wealth. Kyle, go.
Yeah.
No, thanks very much for joining us. Not much happened in April.
No, not at all. I mean, I think a lot of investors were betting on the Iran resolution. And then as the month rolled on, AI optimism certainly showed its head again, which was a dominant theme, of course, in 2025 and then early 2026. And I think this week will be a big test towards not only the AI stocks and the chip makers, but also the software stocks that really struggled early in the year, given some of the AI disruption and kind of the role that they may play moving forward and how that may impact profitability.
Does it make sense how things are going right now? You've got oil up, the markets are up after the plunge, but now they've bounced back and they're all sitting near record highs. Does all of this make sense yet? We don't have a resolution there.
Well, I think things are 2020 in hindsight, but in terms of AI, I think a lot of the market is betting on them being relatively insulated from any prolonged conflict. And that may be the case. I mean, tech has historically demonstrated a pretty resilient earnings profile. And if we are in the midst of an AI supercycle that is benefiting the chip makers and the data centers and all of the different tools that are being made available to the different industries, that could be something that is either proves justified or can act as a parabola and kind of pull back equally aggressive on the way down.
Because it's been quite the change, really, from the end of the year when people were rotating out. And now all of a sudden, we're not sure if AI is going to show us what it can do. And apparently AI is showing what it can do.
I still think that we will see a continuation of some of the underlying themes that drove the first 2 months of the year in terms of that rotation. I think that'll become more present as we get some of the earnings data from the non-AI tech spaces. I think early on in the in the quarter, U.S. banks did a good job showing resilience and easing some of the market anxieties, particularly around private credit. And then it'll be up to industrials and some of the consumer staples and discretionary to show how is the consumer doing, and is the consumer continuing to spend and supporting the economy.
And is that more important than, I mean, tomorrow it's almost like a Super Tuesday, essentially. Alphabet, Meta, Microsoft, Amazon, Qualcomm with the madness today with Qualcomm. Are those ones more important than that group there?
Well, I would say in the end, the markets will follow what the earnings tell them. And I think that is something to keep as a focal point. AI stocks have, to this point, been able to keep up with that earnings pace. But also on the other side too, you've seen multiple expansion and increasingly expensive valuations on that end of things. So I think it's important for investors in that core of the market to remain rather nimble and also humble as this kind of rolls on, and investors have to grapple with the headlines.
And what are you doing with all this?
Well, we're invested much differently than the index.
Yeah.
We're focused, again, still on those other areas that we feel are more, call it underappreciated still, and have sought to benefit from that rotation. And that's largely proven quite justified in 2026 thus far. The reality is that volatility isn't going away. One of the conversations that we've had internally a lot is not only what does 2026 look like, but what does 2027 and 2028 look like, the final 2 years of the Trump presidency, which I think is our Q1 commentary that we put out was titled "The Man with the Hammer," and that references Trump and the decision with tariffs around 2025 and now the Iran conflict. And we think that there will continue to be U.S. policy decisions that drive that uncertainty. And I think that's especially true for Canadians as we kind of roll along with the CUSMA renegotiation and the tariff developments that impact us in our day-to-day.
And then, I mean, with Trump, though, the uncertainty is the midterms. And it's a bit of a toss-up right now, isn't it?
It is, but I don't think that'll do anything to rein him in, quite honestly. If you look at from a historical perspective, what are the final 2 years of a quote-unquote lame duck president, someone who's in their final 2 years, not going to be around after that, they actually tend to turn more towards foreign policy, which is a surprise for some people because the first year and a half of Trump's second term have been very oriented towards foreign policy. Yeah. So I don't think any of the headline volatility that we're seeing is going away. And I think that investors need to plan for that and invest accordingly and be opportunistic, because as we've seen, Trump will, on many occasions, has used the market as his benchmark for success.
And with us and with Trump, CUSMA, we've got the new committee, the new Canadian committee. How is CUSMA, how important is it? I mean, everybody talks about it, but we're still functioning because it feels like, well, it might be gone, it might not be gone, but we're still functioning kind of with. I'm not sure what we have right now.
It's important. Well, I mean, it's still in place and it's still protecting a lot of the goods that go across border. I think one of the things that we can expect to see, particularly over the summer and as the year rolls along, is sector-specific weakness and even company-specific weakness. We've seen that with metal, with steel rather, and autos and dairy, forestry, the sectors that are kind of the key interests for the Trump administration. And then we've also seen it on the company-specific level as well, right? We had Bombardier, I think it was in January, where the whole development around decertifying their jets as an order to expedite the Gulfstream jets. So I think we'll see more of those headlines, but I think Canadians can overcome. And although the economy isn't on the best footing, I think that some of that uncertainty is removed, the stock market, which again is not the economy, can do well as some of that uncertainty is removed, particularly if we can attract some of that foreign investment that may have been sitting on the sidelines.
All right, and let's bring the central banks in just for fun.
Yeah, well, Wednesday is a key date. The Bank of Canada and the Fed are having their interest rate decision. Our opinion is really aligned with the consensus that we don't think that we'll see rates change until 2027 unless something breaks. And really, I think the central banks in North America have been willing to look through the energy surge. The questions will remain around the duration of the conflict and how that plays into inflation. Canadian inflation ticked higher to 2.4% last month, and people will be looking for the commentary from Tiff Macklem and Jerome Powell. Yeah,
and with Powell, could you see a rate cut just because he was going to send it out as a high note or a high note or something, some kind of a note, or is he going to hold steady?
I don't see it. I mean, I know
it's 12 people on.
I even found interesting with Kevin Warsh, the appointee for taking over. I found it interesting around his confirmation hearings and the fact that lowering interest rates wasn't, a primary discussion point, because I think that was some recognition around the fact that maybe it's not as justified, even among the crowd that felt that they were pushing for it 3 or 4 months ago.
And I know there's that political pressure, but it does feel in the States when they get into those positions, they do take it seriously, and the impartiality is important to them. There's always going to be some political bias.
And I do think it'll be on the onus of the Fed, the new Fed chairman, to reinforce that independence, because the U.S. Fed and the U.S. monetary system is a pillar of the global order. And if they are shown as being partisan and influenced by the executive branch, that is a negative for more than just the U.S.
All right, we've got to wrap it up on that note there. But up next, we'll take a look at the markets before the bell, and we'll see why chasing the index may mean taking on far more risk than investors actually need. News for you now. ARC Resources announcing that it is going to be acquired by Shell in a cash and share transaction valued at approximately $22 billion, including assumed net debt. We will have more on this throughout the day here on BNN Bloomberg. And let's take a look and see how things are shaping up on the markets. We'll start with U.S. futures. And the Dow, looking like it's going to be down slightly. Everybody, though, hovering at or near record territory. The Dow's closing in on one, not quite there, but NASDAQ is up slightly, of course, on that Qualcomm news. And stocks up there continue to soar. Asia now. And the Nikkei up by 1.38% again into record territory. The Hang Seng off by 0.2, and the CSI 300 pretty much a wash for today. Off to Europe now. And everybody in the green there, even with the weekend that unfolded in Iran. Maybe they're looking at it as optimism that there were some talks and possible deals being offered back and forth. FTSE up by 0.2, CAC Garon by 0.6, and the German DAX up by 0.85%. TSX on Friday had a bit of an off day, ever so slightly. It's been on a roll, though. It's a little shy today. All right, we're not going to get the board, but it was off slightly on Friday. Some of the movers and shakers, though. Curaleaf up 13%, Celestica 4.4% roughly. First Quantum Minerals down by 4.2%, and Energy Fuels off by 7.22%. Taking a look at the metals board. And gold down by 0.36% at 47.24. Silver also off by 0.69 at 76.41. Copper still holding above $6. It's up by 0.06%, almost a wash. And taking a look at WTI for this morning, it's up slightly 0.72%, right around $95. Brent's back over 100 again, around 103, 104. WTI, though, right now, up by 0.7. Okay, after years of strong market performance, many investors are tempted to measure success by whether they beat the index. But that mindset can quietly push portfolios beyond their comfort zone. Let's see why investors should practice intelligent benchmarking. We're back with Kyle Taylor from TriDelta Private Wealth here for the hour. And intelligent benchmarking. Okay, explain.
So from a practical perspective, I would say that for most Canadians, they should actually care very little about what the index returns relative to the value of their own investment portfolio. And I say that because if someone tells me their goal is to beat the market, my first question is, are you okay with a greater than 20% decline in the value of your investments over any given year? And if the answer is no, or if there's any kind of hesitation, I would argue that beating the market is probably not your primary objective. And then it gets into what is. And for me, in finance, we love our formulas. Intelligent benchmarking, or becoming your own benchmark, really is about inflation plus your needs and expectations, where inflation is, of course, protecting our purchasing power, and of course, a dollar today is not a dollar tomorrow. And then needs and expectations, that's really quantifying your goals both now and in the future, and working backwards to determine what you actually need to see from your investment portfolio to accomplish those goals. And especially true as markets have had a series of great years. And I would argue that whether it's the S&P 500...
But some interesting moments in the middle of them, though, too.
Yes, certainly.
Very interesting moments in the middle of them.
I would just say that S&P 500 or the TSX, as they become more concentrated, they align less and less to what Canadians actually need to see from their investments. If a market falls and there's a March like we had just had, or April of last year, or 2022, and interest rates are rising rapidly, life doesn't stop.
Or March 2020. What a decade it's been.
Life doesn't stop because your investment portfolio fell. You still need, especially if you're a retiree, you need funds to support your lifestyle. You have planned goals that maybe you're not willing to set aside just because that things weren't working as expected. So even for Canadians in all walks of life and different life stages, I think it's important to quantify what you're actually looking to accomplish and then applying that to how it relates to how you're invested.
But it's hard not to get caught up, though, when you hear the markets are at record highs, and it's hard not to. How do you do the discipline?
There's always a certain element of the fear of missing out, particularly as things move higher. One of the ways is really just to demonstrate to people what they actually need to return with their investments.
Yeah.
And having a number, whether that's 5%, 6% annualized, whatever it may be, it can provide a really important emotional check during the bad years to help realign your focus, and particularly if we get some kind of drawdown in any given month stretch or year, or whatever it ends up being around the corner, that could be really important to keeping on track with your long-term plans.
And how do you get yourself to answer it honestly, though?
That's the question. What I always tell people when we're going through the risk profile of creating a portfolio is there's you today when the markets are at record highs, and there's you tomorrow when markets have fallen 20%.
Yeah.
And sometimes the most important conversations you can have around risk are during those periods where things are not working out as they normally would or you would have expected. And that can be really insightful for someone like myself, a professional portfolio manager who's managing a portfolio, because it can allow me to, in the end, develop a portfolio that you can hopefully stick with over the long term.
That's
the key word.
And not look at the markets, right? I mean, that's probably one of the things people should do, is not look at the markets.
To an extent. I think it's always it's too easy of a benchmark to just look and see what the TSX did or what the S&P did, but I think people need to dive under the hood a little bit, whether it's the S&P or the TSX. Like S&P in particular, almost 40% of the index is in 10 companies.
Yeah.
For most, if you're 80 years old, is that appropriate for you in terms of having that AI exposure, and maybe you need a bit more income? What should your portfolio actually look like? People can sometimes create some sort of a blended benchmark as well that they can use to go up against their equity portion of their portfolio. But people sometimes forget, especially in good times, that their portfolio isn't always all equity. There's fixed income, there's bonds, structured notes, GICs, what have you. And making sure that you keep that in focus when you're thinking about the holistic around your portfolio.
How do you deal with people who actually want to beat the market?
Well, I think that's...
When you have clients that want to do
that. And that happens relatively frequently. And I think in particular for younger Canadians who maybe an index is an appropriate benchmark for them because they're focused on the stock side of their portfolio and growing the value. But they still have goals. People still have near-term goals, whether that's if you're a 20-something-year-old and your objective in the next 3 years is to buy a home. Should 100% of your portfolio be in AI? Probably not. Right. So I think that's true for someone who's in their mid-20s, just as it's true for someone who's in their 40s or 80s. It really, that goes down to the heart of intelligent benchmarking, and it's all about you and determining what rate of return you actually need to see from your investments. And ideally, you can err on the side of being more conservative so that if things work out better than expected, you can capitalize on that and be better off for it. But it's something that not enough people give attention in my experience.
Okay, we'll wrap it up on that note there, but we'll be back with Kyle to see why Seagate Technology is on his radar. All right, time to see what's on the radar for Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. And first up, Seagate Technology. What are we liking about Seagate?
So Seagate goes to a broader theme that I'm watching, and it speaks to a few names that we own, and it's all about the AI enablers and who they are. Seagate Technology is a mass storage company that has been integral, maybe flown a bit more under the radar in regards to the AI infrastructure buildup. And they really only have three main competitors in Western Digital as well as Toshiba. Toshiba is probably a distant third, so Western Digital and Seagate have been on a rather similar trajectory.
It's almost a moat around them.
Yeah, exactly. But it almost goes down to the fact that as the AI infrastructure and the hyperscalers are spend, and they need the resources in order to accommodate that. And Seagate, Western Digital, they've played a primary role in providing the necessary infrastructure in order to do so. And if you think about storage, it makes a lot of intuitive sense, because if you look at any of the AI models and the underlying large language models underneath them, they need to retain that info in order to improve it. And that's where Seagate comes along and has been really important in the space.
And are they incorporating? I mean, everything that we talk about, the question AI. How are they incorporating? Do they run a risk of being impacted by it negatively?
Well, if you think they're creating the underlying infrastructure, so they're in the hardware business. They're so the nuts and bolts of the AI data centers, right? So they're a necessary piece, and really there's a lot of supply constraints in Seagate and others in regards to making sure that they have the product available to actually develop these AI data centers. And that's been
an issue for a lot of companies.
But it's been a really great tailwind for a company like Seagate, because people need what they have and they don't have enough of it, and it allows them to have a little bit more pricing power in that respect as well.
All right, let's jump over to Micron.
Micron, again, is another storage company. It is the 5th largest chip maker in the world. They have a few competitors specific to some of the chips that they make, which are DRAM and NAND chips. If you think about how those work, the DRAM chip is dynamic random access memory. Without going too deep into the weeds, they actually are used in the GPUs for NVIDIA. They're used in the data centers, and them and SK, which is and Samsung, which are two South Korean companies, really have about 80% of the market share in that respect. And what I've really liked about Micron in particular, and I think analysts love this stock, is the fact that they are making an effort to sign longer-term commitments with regards to what they're supplying, which has a lot of visibility to investors in terms of long-term profitability. They're facing similar supply constraints in that they're not able to fulfill the total orders that are coming in. And although I think their product, many people equate to a commodity adjacent product, it's something that is necessary in this buildup, and they're certainly benefiting as the chip makers have benefited.
And we've had a few people on talking about quantum computing. What kind of a factor? I know it's not there yet, but when it does get there, are you looking at that and seeing what the interplay that might have with it?
Well, I think when you speak to the actual management teams of these businesses, they're all very opportunistic, and they speak to each other very regularly, especially if you're a supplier to the infrastructure that's being built. You know what's around the corner, and they're constantly looking to develop that space and be an integral player not only in 2026 and 2027, but into the 2030s.
Yeah. So I know they're aware of it, but yeah, quantum computing is a fascinating next step, which I think may make AI almost look dull.
Could be around the corner.
Okay, MKS, the third one.
MKS really is the supplier of suppliers. They actually create the equipment and the tools and the components that and the chip makers would then use to manufacture the chips themselves. They have this strategy, they call it the surround the wafer strategy. So their entire mandate is to make themselves integral in the chip makers and what they're doing. And obviously they've benefited quite a bit in regards to what's going on around them in the AI space and the AI mindset that's driving stocks higher in regards to April in particular. What I've liked about them in particular is their management team has shown a lot of prudence. They've made strengthening their balance sheet a primary objective for them. They're actually paying off $100 million of debt quarterly.
Wow.
In order to allow them.
How much is their debt?
Well, they reduced their net interest expense about 25% just in 2025. So it's significantly come down, and it's become less of a factor for the stock itself. But I think it's, from a prudence perspective, it makes a lot of sense, because if the AI supercycle boom doesn't work out as people maybe expect, it allows them a lot more flexibility to navigate that, rather than having this kind of debt burden overhanging them.
Okay, on that note there, we'll wrap it up. But still ahead, Canada's new Advisory Committee on Canada-U.S. Economic Relations is meeting for the first time today. We'll explore that with our next guest, Drew Fagan, professor at Munk School of Global Affairs at the University of Toronto. And our phone lines will open up soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email, first call at bellmedia.ca. We have a major deal to announce this morning in Canada's energy sector. ARC Resources is being taken over by Shell in a deal valued at $22 billion, including assumed debt. Shell says the transaction strengthens its integrated gas business and expands its footprint in Canada through ARC's Montney assets. The offer is a mix of cash and stocks and represents a 27% premium to ARC's most recent trading price. There are numerous reports that Prime Minister Mark Carney will unveil a sovereign wealth fund today. The fund would be used to invest in major projects the federal government has committed to in the coming years. The plan would also allow individual Canadians to contribute. The details are expected to be presented at an event later today in Ottawa. The Globe and Mail is reporting the federal government will forecast a lower deficit in its upcoming spring economic statement. The update is scheduled to be released Tuesday by Finance Minister François-Philippe Champagne. The current fiscal plan projects a deficit of more than $78 billion for 25-26, $65 billion for the fiscal year that began April 1st. And a quick look at the markets. All of them in the red now. The Dow off by 0.1, not by much. Pretty much everybody awash. You can see the NASDAQ and S&P 500 kind of mirroring each other, off by 0.07 right now. Well, the federal government is recalibrating its relationship with the U.S. Prime Minister Mark Carney unveiling a new advisory committee on Canada-U.S. economic relations, which will meet for the first time today ahead of CUSMA renegotiations. Joining us now to discuss what the initial meeting could touch on and more is Drew Fagan, professor at the Munk School of Global Affairs at the University of Toronto. Drew, thanks very much for joining us.
Hi, Roger. Thanks.
What can we expect is this a kind of get to know you meeting? I imagine a lot of them know each other, but this is kind of let's settle down and get a game plan lined up.
This is typical. This was done during the original free trade negotiations in various ways. NAFTA, the CUSMA negotiation, negotiating with Canada and Canadian negotiating stances are complicated. It's a regional economy, the power of the provinces and our federal structure. This is really the senior advisory committee made up of, interestingly and importantly, some ex-conservative politicians as well as business interests. And there will be other sectoral organizations as well as the government really gets down to work with the White House.
How much of the what's going on back and forth between the U.S. before negotiations even start is playing a role, and what would be considered a success come summer?
Well, there's a sort of a deadline of July 1st. The language in the original agreement isn't very clear on the review. That's the official word of CUSMA, the USMCA, 6 years after it was signed. It's unlikely that there will be an agreement by then, given the timing. We're already at the end of April, and the complicated structure of negotiations among the three countries, which took place to some extent in the previous negotiation, 2018. Right now, the U.S. and Mexico are talking more than the United States and Canada are talking, let alone the more typical trilateral negotiation among the three parties. There's a lot of rhetoric being thrown around, particularly from the White House, the Commerce Secretary insulting Canada last week. So the Canadian side has tried to hold back a little bit, but reports are that the engagement is now increasing. I would expect later in the summer, there'll have to be some sort of statement by July 1st, but later in the summer into the early fall, we'll have a better sense of what an agreement, assuming there is one, and I think there likely will be, is going to look like.
And how much of an impact is Trump having on the actual negotiations that are happening behind closed doors that we don't really hear much about? Is what he's saying publicly, is that carrying down, or are they being more realistic?
Well, at the working level, which is the senior working level, the chief negotiator, Janice Charette, the ambassador of the United States, Mark Wiseman, I think that is sort of discounted to a certain extent. But when you also have the Commerce Secretary making the kind of comments he's making, let alone the president, that does roil the waters a little bit. And you saw the Prime Minister say last week, the rhetoric is unhelpful, or words to that effect. Let's get down to business here. And Canada does have cards to play, and that frustrates the United States, I think in part because the Mexican government is definitely looking to do a deal faster than Canada is. Because I think we see ourselves as, one, politically, it's difficult for the Prime Minister to make a deal quickly because it'll look like he's rolled over. And secondly, because we think reasonably that we have, as I say, more cards to play in terms of critical minerals, in terms of energy, in terms of other sectors as well.
The U.S., after the Supreme Court announced the tariffs were illegal, they initiated a review under Section 122 which has a deadline of July 23rd. Does that get looped into these negotiations at all?
Officially, no. Unofficially, yes. So you see, including in the announcement of this advisory committee, kind of the headline is sort of, don't forget that somewhere close to 90% of all our exports still go into the United States tariff-free. We've got the best deal in the world with regard to that. Well, okay, thanks, but we were supposed to have free trade, and we never really had it completely. We certainly don't have it now, given that there's any tariffs. So that is a factor, and the challenge in many ways is what success looks like, as it always is. The government is still saying that success would be, and we hope that the tariffs are off entirely. At the same time, well, they really have sort of given up that a little bit lately and said, we do expect tariffs to continue. They want to get them down. They want to minimize them. And Trump still talks like the tariff man. And it's hard to do what is supposed to be titularly, at least, a free trade agreement when you don't even have a complete elimination of tariffs. So at the end of the day, we're probably going to have a deal, say, in the fall. And there is a political question as to whether you try to delay until after the midterms election in November, given that the Republicans may stop controlling Congress at that point. The deal that you have to sell is to the Canadian public is probably not going to be as good a deal as we had previously. And you can see the Canadian government sort of preparing for that. We are playing some degree of defense, but at the same time, as I said, we do have cards to play, which is the reason why we're going to play this out.
I just want to bring it back to the committee. Is this committee? It's quite diverse, as you mentioned. There's a couple of conservatives, former conservative leader on there. Is this too big a tent? I mean, Carney has made that his kind of feature that he's got a big tent going on there. And could it devolve down into infighting, do you think? And could that have an impact on how the U.S. perceives Canada?
There may well be infighting once the government gets down to what kind of concessions it has to make. Supply management is one obvious one, probably be in the Canadian public interest, at least consumers, but significant politically. So, yes, there are diverse interests at the table. I don't think they'll be fighting amongst each other, but they will put forward to the minister responsible, Dominic LeBlanc, the position of the sectors they represent. And all major sectors are represented. There's no question about that, as well as the prime minister seeks some degree of national unity. As you noted, a couple of senior and respected conservative leaders and cabinet ministers. So you've got a big tent. The challenge with a big tent is a lot of people want to talk. I think that's a price worth paying.
All right, we've got to wrap it up there, Drew, but thank you very much for joining us.
My pleasure.
Drew Fagan is a professor at the Munk School of Global Affairs at the University of Toronto. Still ahead, shares of Qualcomm are soaring in the pre-market after a tech analyst suggested the chipmaker is partnering with OpenAI on a smartphone. We'll have more on this after the break. Qualcomm is soaring in the pre-market after a tech analyst said his industry checks revealed that OpenAI was working with Qualcomm to develop smartphone processors. For a closer look at the story, we're joined by Bloomberg's Ryan Blistelica. Ryan, thanks as always for joining us. It's quite the jump for it. Last time I looked, I think it was about 11, 12% on one tweet, essentially.
Yeah, good morning. Thank you for having me. Yeah, there is a lot of excitement about this report today, although I would say that it comes at a time of pretty uncertain prospects for Qualcomm. The stock has been really under a lot of pressure this year on the impact of these higher memory prices, which we've talked about in the past. So higher prices for memory-related chips. There's some concern that will impact, say, smartphone demand for other kinds of consumer electronics, all the kinds of major markets that Qualcomm focuses on. So the stock has been under a lot of pressure. Now it's been rebounding lately as part of the broader semiconductor rebound. The semiconductor index is actually on track for a record 19th straight positive session, and Qualcomm has participated in that somewhat. But otherwise, sentiment has been pretty muted here. So any sort of report of good news is something that's certainly being welcomed.
All right, and do we are we getting any details on how this might unfold or what we might see?
There's a few details in the post that you mentioned before. Basically, the idea is that we will start to see mass production in 2028. Some things are still being finalized right now. So this is sort of a long way away, and it hasn't been confirmed yet by any of the companies involved. We did reach out to them. We haven't yet heard back. But certainly, at least in the moment, it seems like there's a lot of optimism because of over the longer term, Qualcomm has been losing its very important relationship with Apple, which is developing more chips internally. So the idea that they can get a major new customer in the form of OpenAI, the idea of having an OpenAI smartphone, very exciting, at least in theory, and that is at least enough for the stock this morning.
And what would that do for competition?
Really remains to be seen as we get more and more details out of this, assuming we do get confirmation from the companies involved. But assuming that this is involved in, say, modem chips or something like that, that would be pretty beneficial for the company. I mean, obviously, it depends on when do these phones come out, what does their initial pricing look like, how much demand is there for these kinds of chips. There's still a lot of questions out there, but certainly the idea of getting such a high-profile new customer would be exciting for investors.
All right, we'll wrap it up there, Ryan. We'll wait for more news from this throughout the day from you. Thanks very much for joining us. Bloomberg's Ryan Blistelica. And so let's bring Kyle Taylor from TriDelta Private Wealth back in on this and get your thoughts on this. I'm just fascinated that one tweet can make a company jump. Actually, 14%, I think, is what they hit.
Well, as someone who's held their Qualcomm stock, I love it. But I think it's more about, it's a function of the AI mindset more than anything else. I think we've seen that on a few occasions already with some of the AI rebrandings that other names have had, or Intel popping 24% on Friday. It's more about the mindset that's driving the rally today.
And does this bring the OpenAI? Is this new for OpenAI, or where's it going with it, do you think?
I don't think so. I think it'd be interesting to get the details, assuming it does get confirmed. If it doesn't get confirmed, I wonder how the stock will react. But because James was right, it's had a rough time up until the recent rally, and it's been under some pressure.
And Qualcomm, you're liking it because of what it's doing, and it's had, as Ryan mentioned, it's had a good run for the last while. It's kind of ridden on the coattails of everybody else, hasn't it?
Well, I think you could point to a lot of the names that have ridden on the coattails of everybody else. And
I shouldn't say ridden on the coattails, but they've enjoyed
they all
the surge.
Play their role. They all play their role, and they all have
a rising tide.
Yes, a rising tide lifts all boats. So there you go.
All right, we'll wrap it up on that note there. We've got lots more to talk about. Let's see. what could be an attractive investment opportunity. We're going to bring Kyle back and to talk about that. Also, still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including Nutrien. Let's take a look at some of the notable analyst calls and recommendations. Barclays upgrading its rating on Nutrien to overweight from equal weight and raising its price target to US $85 from $80, citing improved potash market indicators. The firm raised its estimates reflecting prolonged uncertainty surrounding the Iran war and an expected longer-lasting disruption to natural gas supply and its implications for ammonia production. GE Vernova is falling in the pre-market after BNP cut its rating on the stock, citing growth is now harder to sustain. Tariff impacts remain a significant concern for GE, forcing the company to explore alternative sourcing and contractual protections. At the same time, the wind segment continues to lag as a drag on profitability. Toromont Industries has been raised to a buy at Canaccord with a price target of $235. This upgrade comes as Toromont has been showing signs of strong performance, with shares trading near 52-week highs, supported by robust Q4 2025 results that beat estimates and a 37th consecutive dividend increase. Their Q results are expected tomorrow. When we come back, we'll have all your questions on First Call. And time for First Call and first email, and that one is from Glenn. And Glenn says, do you think this ARC Resources announcement is a done deal, or may there be additional bidders for ARC?
Still recent news, but it appears to be
a
done deal, and the details of how that'll work for shareholders has been released, which leads me to believe that it'll go through as expected.
And do you see anybody else stepping in, saying, meh?
I mean, it seems like a pretty good deal for investors, and relative to the premium that they're getting. And I think the acquisition is a good one for Shell as well. And I think hopefully speaks well to the Canadian side of things in regards to energy.
Yeah, 27% premium. That's in the ballpark for it.
Yeah, I mean, I would say so, especially considering the run up that we saw in March. Obviously, it's pulled back a bit since then, but it's appears to be an interesting acquisition from Shell.
All right, and yeah, 75% in Shell shares, 25% in cash. Is that?
Yeah, the fact that those details, just getting to Bruce's email, the fact that those details are out there, and when I was reviewing off air before this, it appears to be pretty in there.
All right, we'll leave it on that note there. This email now from Bruce, and what are your thoughts on AMD? Is it time to take some profit?
AMD is a name that I like. I think that we were just talking about how the rising tide lifts all boats, and AMD has been certainly an example of that. They benefited also on last week's news around Intel. If you're comparing AMD relative to some of their competitors, Intel in particular, I like AMD a lot more because I think they're well positioned to respond where Intel has several supply constraints. If you're sitting on a big capital gain and you're wondering, is now an okay time to take some money off the table? Absolutely. I think that's true within the entire AI space, given the month that we've had and the few years that we've had. So as long as you're comfortable with the position, then I think that's what's paramount here. Okay.
Let's get some more emails in here. This one's from Len. What is your outlook over the next year for Allied Properties REIT?
Allied's had a rough go. They're almost down 30% over the last 3 months. They did an equity raise recently to pay down debt. They also cut their payout, and investors did not respond well to that. And as a result as well, they were removed from the Dividend Aristocrats Index for the TSX. So I think there's many REITs that are having to put an emphasis on some sort of debt pay down strategy, and that's one of the reasons why it's been a rather difficult several years for REITs in general. And in terms of Allied, it's not one that I own. It's not one that I particularly am looking to pick up today.
All right, we're going to get one more email in. This one's from William. Please have your guest comment on the current pricing of the big six Canadian banks and whether they are priced for perfection in the coming quarters. If they miss expected street earnings forecasts, will that significantly impact current pricing?
Well, I think even if you were watching at the top of the hour, I mentioned that markets will ultimately follow earnings. And so I certainly think that if the banks have a rough go of it, or some of their commentary around the Canadian economy and the other markets that they service is negative, then that will certainly justify a repricing. But I also think the Canadian banks are structurally sound, and from a fundamental basis, they've been doing a phenomenal job. So I continue to, one of the aspects that we were adding to actually a lot in March was financials. And Canadian banks, U.S. banks were an example of that.
And they've had a good year. What are some things that might stir the pot? What might be potential headwinds for them?
One of the things that I'm watching actually is early 2027. So with regards to the wealth management segment of their business, there's a new regulatory release that was beginning 2026 for it's called CRM3. It's total cost reporting, and it's effectively the banks and everybody else is going to have total fee transparency. And I think at the branch level, a lot of people aren't aware of the fees that might be being incurred with some of their investment portfolios, and that is a particular exposure to that level of the Canadian banks.
And so could that hit one more than others, or is it?
I think it could hit them all. I think you'll have a large segment of the market that maybe it's not news to them, but I think if people start questioning their fees with regards to the branch level, that could drive people looking around, and maybe it creates more competition among the banks. But I think it could be it's a segment that I'm interested in watching over the next year.
Got to wrap it up right there, but thank you as always, Kyle, for joining us. Kyle Taylor, wealth advisor and portfolio manager at Tri-Delta Private Wealth. Andrew Bell's up next with the Open. Trading gets underway in 30 minutes. Have a great day.